Now, we've heard a number of guests on this show cautioning about too high tech valuations and warning against those names. And the S&P tech sector has dropped about 2% over the past week. But my next guest says not so fast. Big cap tech is actually undervalued, and the pullback may have created some opportunities. Joining me now is Chris Davis. He is chairman and portfolio manager at Davis Advisors. And how do you like that for an intro, Chris?
Well, I think we got to add a lot of nuance to that, Kelly.
Not allowed.
The issue is this. Look, there's likely to be a lot of bad headlines on tech in the next 6 months, the next year. We're in the front end of this regulation cycle and so on. So I actually think both sides could be right. I think you could really have short-term headwinds that could produce real buying opportunities in these names. But I think that it's early to be very optimistic about the next 6 months, the next year. On the other hand, we're long-term investors, right? So if I was to think about, over this generation, look, these are companies that are still relatively early in to what might be 4 decades, 5 decades of sort of real leadership. These are the blue chips. Earlier, your guests were talking about Procter and Gamble and Johnson. Think of those companies in the 60s. They already had long histories. They had 40, 50 years to go. So I think if you're going away to a desert island for the next decade or more, absolutely buy them, put them away. If you want to be clever with valuation, I think we should expect some headlines and a bumpy ride over the next few months or even the next year.
So sort of the Berkshire buy a great company at a good price, not a good company at a great price type of thing. And I bring up that analogy for a reason. I mean, I often think of you as that style of investor. So when you're looking at big cap tech and talking about the opportunity that you see over, the next couple of decades, and yes, Berkshire owns Apple, but I ask myself, why don't they or didn't they, or at what opportunity point could they have possibly gotten in and owned some of these names? I don't know if you saw Bill Smead's piece the other day saying, where were they in the spring and summer even of 2020? I mean, the market had given these amazing opportunities. Berkshire did nothing. So it doesn't even have to be big cap tech. It's just, where are they? And again, is this kind of the obvious then play, the holding play for the next few decades? And again, I don't know where that leaves Berkshire investors.
Well, Berkshire Hathaway has been one of the great compounding machines of a generation, and it also still has a long way to go. The most powerful characteristic of Berkshire and of Berkshire's leadership has been their ability to adapt and learn. And so the Apple investment was a staggering example. I mean, imagine at that stage with an octogenarian CEO getting that investment so right. You could say it was late, but it was a huge amount of investment, a huge value creation. I think they're also first to admit that missing Google or missing Amazon were mistakes. But the idea that you would need to worry if you had Berkshire Hathaway in a trust for your children about it compounding wealth over the next generation, you don't need to worry. You have other stuff to worry about. And of course, in a galloping bull market, it's always the old saw that, oh, Berkshire Hathaway is a dinosaur. We heard this in the late 90s when they didn't own any dot-com stocks. What was amazing is how that company learns. It is built to last. It is built with the idea that they are in a sense trustees of their shareholders' wealth. They are thoughtful and careful. So I think those stories of their obsolescence are always feel to me a little premature.
Shepard Smith here. Thanks for watching CNBC on YouTube.